I'm sure you know the NPS or the National Pension System. It's a popular retirement savings avenue that also offers good tax benefits, right? Well, did you know that it applies only to the NPS Tier 1? Wondering what did I just say? Let me explain. The NPS offers two types of accounts, Tier 1 and Tier 2. Tier 1 is the more popular of the two. So when investors talk about the NPS and its many advantages, they often refer to the Tier 1 account. This is more than evident from the assets of Tier 1 and Tier 2. As of March 2023, Tier 1 assets stood at more than 1 lakh crore. On the other hand, Tier 2 assets were just 4,000 crores, just 3.7% of the Tier 1 assets. What about this Tier 2 account then? Is it also useful like its Tier 1 cousin? And if yes, then how? Hello and welcome to ET Money's YouTube channel. Today we are going to talk about the NPS Tier 2 account. We will discuss its feature, investment options, their return profile and how Tier 2 compares with mutual funds. So this video has a lot of action. Do watch till the end to get the most out of it. But before I start, let me tell you we have some of the most insightful videos on the NPS. We have a video on the features of the NPS, the best NPS managers for Tier 1 and the top 5 changes and so on. I have mentioned their links in the description, so do watch them as well to get a complete understanding and perspective on the NPS as an investment option. But for now, let's start with the features of the Tier 2 account. The Tier 2 is an optional investment account. It's optional because you can have a Tier 1 account only but not a Tier 2 account. And then it's an investment account and not a retirement one like Tier 1. So you can invest and withdraw from the Tier 2 account anytime. But do know that it's mandatory to have a Tier 1 account to open Tier 2 account. You can only open or operate a Tier 2 account with a Tier 1 account. So in other words, it's an optional investment account for those using the NPS as their retirement vehicle. Like the Tier 1 account, it offers multiple asset classes, equity, government bonds and corporate bonds. These are also called asset classes E, G and C respectively. However, there is no alternative investments fund or asset class A in Tier 2. It's available only in Tier 1. Again, like Tier 1, Tier 2 has active and auto investment choices. The active choice lets you choose your asset allocation. The auto choice offers 3 life cycle funds with predefined asset allocation across equity, government bonds and corporate bonds. This asset allocation automatically changes with age. Now, one notable difference between Tier 1 and Tier 2 account is that Tier 2 allows investing 100% in equity under the active choice. In Tier 1, the maximum is 75%, but you can allocate up to 100% in Scheme G and C, whether Tier 1 or Tier 2. Now, to understand auto and active choices better, you can watch our foundational video on the NPS. Now, there are 10 pension fund managers in the NPS Tier 2, each managing each of these 3 asset classes or schemes. So overall, there are 30 schemes. We will talk about the performance of these schemes shortly. Let's first look at the taxation of NPS Tier 2 account. So as far as the tax benefits are concerned, Tier 2 offers none. The withdrawals made at the gain are also taxable at the slab rate. Tier 2 also has a tax saving avatar. It's called the Tier 2 Tax Saving Scheme or TTS. It allows the deduction of up to 1.5 lakh under Section 80C. However, the TTS is currently available only for government employees. Now, the differences between the NPS Tier 1 and Tier 2 accounts are summarized in the table on your screen. You can pause the video and take a look at them. One more thing, transferring funds from Tier 2 to the retirement or Tier 1 account is also possible. The reverse of this, however, is not possible. So these are some of the features of NPS Tier 2 account. Next, let's look at the performance of NPS Tier 2 schemes under various fund managers. If you are interested in the performance of Tier 1 fund managers, we have covered that in one of our earlier NPS videos. You can find its link in the description. And if you want to invest in Tier 1, you can also do that on the ET Money app. You can even start an SIP in NPS Tier 1 on ET Money. To assess the performance of Tier 2 fund managers, let's use a metric called rolling returns. We will assess the average 5-year rolling returns of all the eligible fund managers across the 3 asset classes E, G and C. Now, our regular viewers may already know the meaning of this metric and why we use it so often. But if you need help understanding average rolling returns, worry not. Here is a quick explainer. Now, rolling returns are all specific return instances over a time span. So, a 5-year rolling returns are all instances of 5-year returns over a time span, say 10 years. When these instances are averaged, we get the so-called average rolling returns. Because the average rolling return figure comprises numerous data points, it is more reliable than plain trailing returns. Now, out of the 10 fund managers currently available, 3 are relatively new. So, we will have to remove them from our analysis due to a lack of sufficient data. This leaves us with 7 fund managers. Let's compare the performance of these 7 fund managers across asset classes or schemes E, C and G. Let's begin with the schemes that invest in equity or asset class E. Now their investment universe is the top 200 stocks by market capitalization. They can also invest in equity funds, ETFs, derivatives of the top 200 stocks or indices, IPOs and OFS, all subject to specific rules and limits. The performance of the 7 fund managers of schemes E is on your screen now. Tier 2 schemes have average 5-year rolling returns ranging between 11.71% and 13.54%. That's a tight range, with the difference from the median ranging from minus 0.84 to 0.99 percentage points. Next, let's talk about schemes investing in corporate bonds or asset class G. Apart from government bonds, these schemes are also allowed to invest in gilt mutual funds subject to certain limits. Plus, they can invest in securities where the government guarantees the principal and interest. The table on your screen mentions the average 5-year rolling returns of schemes G along with the difference from the median returns. Again, the difference from the median is in quite a tight range except in one case, LIC Pension Fund. LIC is the undisputed leader in this segment and has a wide outperformance over the median returns. Lastly, let's see the performance of schemes in C. Now, Scheme C invests in corporate bonds, including those issued by the banks and financial institutions. They can also invest in units of debt funds, debt securities issued by REITs and InvITs, debt ETFs, etc. All these investments are subject to certain conditions and limits. On your screen, you can find the performance of Scheme C. The returns are again in quite a tight range, with a difference from the median between minus 0.17% and 0.54%. Now, if we assign ranks to the fund managers based on the returns across the schemes, we can get a combined relative picture. The SDFC and ICICI Prudential schemes appear in the top 3 in all the cases. On the other hand, all schemes of Birla Sun Life have ranks ranging from 5 to 7. So SDFC and ICICI are the best performance. As of now, the schemes of Birla Sun Life look avoidable. The rest of the fund managers have a combination of good, bad and average schemes. But notably, the returns of various tier 2 schemes have moved more or less in tandem. So expect no fireworks on the basis of scheme selection here. One significant development that has happened just a couple of months ago is that now you can pick different fund managers for different asset classes in voluntary and corporate tier 1 models and in tier 2 as well. Currently, the top fund managers in the tier 2 account are SDFC for equity and corporate bonds and LIC for government bonds. Okay, given that you invest and withdraw anytime from tier 2, one can also think of them as an alternative to mutual funds. So how does the tier 2 compare with mutual funds? That's what we will see in the next. Let's begin with a comparison of schemes in E with equity funds. The appropriate equity fund categories for this comparison would be active and passive large cap funds. That's because schemes E have a heavy bias towards large caps despite being able to invest across the top 200 companies by market capitalization. Still, for the sake of argument, let's also include the Nifty Large Midcap 250 index in our comparison. This index invests 50% each in large and mid caps and can invest in the top 250 companies by market capitalization. We recently did an analysis of the Nifty Large Midcap 250 index and we found this index quite promising. You can check the video link in the description if you are interested. The chart on your screen compares Scheme E's category average 5-year rolling returns with those of active large cap funds, the Nifty 50, Nifty 100 and the Nifty Large Midcap 250 index. Now, schemes in E trail all its competitors in terms of returns, but while talking about equity, it's also worthwhile to check the volatility of returns. Now, we measure volatility via a metric called standard deviation. The higher the standard deviation, the more the volatility. Scheme E is more volatile than active large cap funds, the Nifty 50 and the Nifty 100. It's less volatile than the Nifty Large Midcap 250, but then that's understandable given the higher midcap exposure to this index. So risk-wise and return-wise, it doesn't offer any advantage against equity funds. While Scheme E failed to beat its peers on volatility, you can very well beat life's volatility by getting adequate term and health insurance. And you don't have to go anywhere else for them. Money provides you term insurance and a 1 crore health cover plan too. Do check them out. Okay, so another major spoiler for Scheme E is the taxation of NPS Tier 2. The gains from NPS Tier 2 are taxed at the marginal rate, that is as per your tax slab. On the other hand, gains booked within 1 year of investing in an equity fund are taxed at 15%, and gains over 1 lakh booked after 1 year are taxed at 10%. So if someone is in 20 or 30% tax bracket, equity funds are more attractive than the Scheme E of NPS Tier 2. Alright, let's now compare the returns of Scheme G with mutual funds. We will use two mutual fund categories here, gilt funds and gilt funds with 10-year constant duration. Gilt funds invest in government securities or G-Secs. Gilt funds with a 10-year constant duration also invest in G-Secs, but the securities are of longer duration such that the portfolio's overall duration is 10 years. Now Scheme G does better than mutual funds here. Against the returns of 8.04% by gilt funds and 8.52% by gilts with constant 10-year duration, Scheme G has generated 8.71%. Alright, let's also see the performance of Scheme C vis-a-vis corporate bond funds. Scheme C does better than corporate bond funds by a wide margin. Against corporate bond funds 7.36% 5-year average rolling returns, Scheme C has generated 8.43%. What could be the reason for the outperformance of Scheme G and Scheme C then? Recall that one of the major advantages of NPS is a low-cost structure. The NPS schemes, whether Tier 1 or Tier 2, can't have a management fee of more than 0.09%. On the other hand, the direct plans of gilt funds and corporate bond funds cost between 0.25% and 0.27%. Now, after the removal of indexation benefits 2023, the taxation of Scheme G and C is now par with that of debt funds. Gains booked on Schemes C, G and debt funds are all taxed at the slab rate. So, this was the returns perspective of the Tier 2 versus mutual funds. There are few other things to consider when comparing NPS Tier 2 and mutual funds. First, the NPS allows changes in asset allocation 4 times in a financial year. You can also change the fund manager once in a financial year. These limits are available separately for Tier 1 and Tier 2 accounts. Now, these changes don't attract any tax. However, if you were to make such changes in mutual funds, the resulting gains would be subject to tax as per the applicable rules. Of course, hybrid funds are also available that provide automatic asset allocation and tax-free rebalancing, but you can't decide the specific percentage of asset allocation with them. You can only choose from the options available. Second, the NPS has an auto choice that automatically adjusts asset allocation based on age. There is no such feature in mutual funds. Third, mutual funds are quite a varied lot. As many as 37 categories are available across equity, debt and hybrid. There are even gold and silver funds. So you get a multitude of options. While with the NPS, the choice is comparatively narrower. Gold is missing from NPS asset mix. Fourth, let's remember that you can use NPS Tier 2 only if you have an active Tier 1 account. That means you must maintain and manage the Tier 1 account to keep using the Tier 2 account. There is no such compulsion in mutual funds. So you have higher flexibility there. So, given all this, should you go for NPS Tier 2? Well, that's what we'll talk about next. Perhaps the biggest limitation of the Tier 2 account that it can only be opened and operated if you have an active Tier 1 account. So if you have an active Tier 1 account, it may make sense to look at Tier 2, especially for the schemes G and C. In that form, it could be a comparatively cheaper and more rewarding option for debt component of your portfolio. For ease of management, you can even consider Scheme E, though it failed to impress us. But other NPS features such as the changes allowed in asset allocation and fund managers and the availability of auto choice can help tolerate its performance woes. But do know that Scheme E invests majorly in large caps. So consider it only if your purpose is met by investing in large caps alone. A good application would be conservative portfolio which needs inflation protection. And if you don't have an active Tier 1 account and don't plan to have one, no way should you consider Tier 2. Mutual funds should be your go-to option then. Lastly, do assess your requirements as well. If you have a well-functioning mutual fund portfolio and the Tier 2 seems to add complications in overall scheme of things, feel free to give it a miss. And with this, we have come to the end of this video. I hope you found the video useful and all your doubts about Tier 2 account were solved. And if they were, do share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.